Doug Montezella. Today, I want to talk about debt. I want to talk about demystifying debt and offering a different perspective, that debt is not a bad thing. Debt is a tool to build wealth. There's a lot of things out there that says, oh, you want to pay off your loans, pay off your mortgage as quickly as possible, and I want to show you today why that might not be the best idea for you. And specifically today, I want to talk about two main areas that we most deal with the most, right? Especially as new college graduates and just the way college has gotten so expensive, student loans, and number two, mortgages. And I want to show you, and hopefully you walk away with, hey, maybe I'm going to change my strategy of being a little bit less aggressive in my loans and then look to invest in other places of higher return. So here's why. So I have a little bit of information here on student loans. So the average amount in America of student loans for any one graduate is $37,000. The average minimum payment, it's just crazy, is $50. So what does that mean? Why the heck is the minimum payment so low from these banks or whoever's offering these loans? It's because they want to keep you in debt forever. Because if you stick to that minimum payment, you're going to stay in debt. You're never going to pay down that principal. You're just going to be, that money's going to go towards the interest every month. And again, principal, when you pay off principal, that's the actual amount that you owe. This, for example, is your principal amount. And each payment should take some out of that to a degree. And additionally, the average interest rate in America for student loans is between 4 to 6%. If you're on the lower end, it's because you likely had a subsidized loan, maybe through the government, or if you're on the 6, 7, or 8%, likely you had just a private loan from a lender like a bank. So why should you not pay off this number, right? You got this monkey on your back, you graduated college, you're trying to save money, you're getting a job, and you just see this massive number and that's all you focus on. Here's why you shouldn't do that. Because let's look at this step number one, right? That $37,000 in debt, year one, which again is the most interest you'll ever pay because your principal is the highest, right? Or as years go on, this number is going to go down, this stays the same, and your interest is going to continually go down year over year. So your worst case scenario is that you are technically docking your pay each year by $1,800. Is that a crazy amount? No. In the grand scheme of things, that's not. And really, to set yourself up with a great strategy is you need to think broadly. You need to think about your net worth, because you need to understand where you're putting your money, right? Whether it's towards loans or investments, you want to make sure that's lifting your net worth as quickly as possible, and especially while you're young. So with that being said, first of all, not a big amount. You're essentially docking your pay that much. Another key thing is one of the fundamental principles that's always good to keep in mind is that anytime you pay off debt, that's essentially you're getting a return on that money, right? Your return on that money is not having to pay the associated interest on that each year. So let's say you pay an extra $1,000 a month towards your student loans. You're making a 4 to 6% return on that investment. Is that the best return you've ever heard of? No, right? So I had another video on the S&P 500. Over the last 130 years, that's a 10% return. So that's the minimum that you should be looking at, right? For an actual, that's a percent sign. And again, put your money towards your 401k, right? 401k, maybe a brokerage account, or maybe an investment property that you see or identified in a really high appreciating area with potential rental income. So this is critical here, absolutely critical, because when you're young and you graduate college, you're at your youngest years, right? So that's the most important time for piling money into your 401k. And number one, right, you're going to get a higher rate of return because you're going to get that around 10% per year. And additionally, you're going to get tax incentives, right? Because with these retirement accounts, the government set those up, right? You get taxed much less. So way better option here. Don't be intimidated. It's only $1,850. And at the end of this, when you pay that down, that's the most you'll be saving yourself. And this drops drastically as this principal drops drastically over time. Secondly, mortgages. A lot of people say, pay your mortgage off quickly, it's bad loans. Again, average amount for mortgages in America is $202,000. Average interest rate is 4%. So again, same principle applies here, right? You have your mortgage, probably something like this, is around $1,400 per year, ballpark. And the nice thing is this is going to stay relatively consistent over 30 years time, because you're locked into a 30-year mortgage. Yes, your tax will go up a little bit. Yes, your insurance will, but your principal and interest payments, that will remain capped for 30 years. So not much upward movement in this, right? And what's going to happen to your living expenses? If you were to rent, for example, right? The rent is going to go up every single year because of inflation. You're a lot more protected in that over the long term in a piece of real estate, because that price is fixed. So with that being said, you're paying the same amount, so you're technically saving money over the long term. And that money, so $1,400 in 30 years time or 25 years time, and you're getting the back half of that loan, $1,400 with inflation is going to be the equivalent of like today's dollars of $700, because money's less valuable, because the government constantly prints money to devalue it so they can pay down their own debts. Additionally, same principle as well, this 4%, right? Any additional money you pay, you're making a 4% interest rate. Don't waste your money. Time value of money, you can make a 10% return on that. You can be maxing out your 401k. You could be buying additional real estate instead of locking all this capital up in a single house, where you can buy additional properties, right? You can go in your 401k. You can open up a brokerage account. All of these things are higher than a 4% return. So don't shovel your money in a mortgage. Don't shovel your money into student loans, because these are not high yield investments. Think about it broadly from your net worth standpoint. You want to put your money towards what's going to be the highest interest rate. And yes, I didn't go into the details, but I don't expect you to pay the minimum. I wouldn't pay the minimum payment here. I would pay the minimum, plus I'd find which loan is the highest interest rate, and I'd pay an extra $100 towards that one, or $200. But again, I wouldn't get crazy aggressive with this, because I'm focusing on the higher yield investments like your 401k, real estate, rental properties, things of that nature. Same thing for the mortgage. It's a 4% interest. That means any additional money you pay towards that, you're only getting a 4% return on that money. Understand that these are low return investments. Don't stress about debt. Debt helps you build wealth. You can buy multiple properties instead of throwing all your money in there. It's a tool. Debt is a tool to get access to more money, and the fee you pay for that is interest. And if it's a low interest, that means you have a lot higher likelihood to make money off that money that you were given, way higher than the interest rate that they're charging you to obtain that money. Hopefully this made sense to you. Hopefully you're going to really look at your student loan payments. You're going to say, hey, what makes the most sense here? And focus on the right higher return investments in your portfolio to grow your net worth significantly, and don't do things that are going to suck all your capital that could be making good returns for you. So thanks for listening.